The Art of War. Sun Tzu wrote it 2,000 years ago. The Art of War by Sun Tzu is the holy book of military strategists and is famous all over the world. Required courses for West Point and Harvard MBAs. The market is a war zone. You need to be a winner to survive. In today's story, we apply The Art of War by Sun Tzu for investors and speculators. If you enjoyed this video, please click the like button and subscribe to our channel. Thank you. Please note that our content is purely for storytelling purposes and should not be construed as investment advice, nor do we solicit investment funds. Ping Fa. Know yourself and your enemy. Sun Tzu said, if you know yourself and the enemy, you can fight 100 battles without any loss. When you have enough intelligence and a deep understanding of your situation and that of your opponent, you will never lose a battle. Don't know the enemy but know yourself, one win and one lose. When you know yourself deeply but don't understand your opponent's situation, your chance of winning is only half. If you don't know the enemy and yourself, every battle will be derailed. When you don't understand your own situation and you don't understand your opponent's situation, you will lose every battle. If you play golf, you wouldn't want to compete against Tiger Woods. If you play mahjong, you do not want to play with con man. Unfortunately, in the stock market, you have to contend with professional traders like me and deal with all kind of con man. Research indicates that 95% of speculators lose money. The reason is clear: small speculators who know how to win quickly become big speculators, while big speculators who don't know how to win soon become small speculators. A big speculator's average bet is much larger than that of a small speculator, so when they win, many small speculators lose. It's like how many small fish a great white shark consumes daily. The market wisdom goes, if you want to become a millionaire quickly, start with $10 million. Unless you are a professional trader, your chances of winning are slim. You are better to stay away from the market. Of course, you may be able to learn enough knowledge to become a profession from our channel, so subscribe our channel now. We should not afraid of the enemy, but we should be afraid if they have culture and know Ping Fa. Sun Tzu said, all warfare is based on deception. Hence, when able to attack, we must seem unable. When using our forces, we must seem inactive. When we are near, we must make the enemy believe we are far away. When far away, we must make him believe we are near. Hold out baits to entice the enemy. Attack him where he is unprepared, appear where you are not expected. How to use the above strategist is based on actual situations and cannot be set up beforehand. Note: next, we will see how our enemies use those Ping Fa. Know your enemy. News deceptive tactics. News deceptive tactics were famous for the king of speculators, Jesse Lauriston Livermore. His strategy is wait for a stock he purchased to rise to the point where he would earn a substantial paper profit, and then confiding to a reporter from the New York Times or other influential newspaper that the stock was a good deal. Livermore would then sell off his huge position, selling in the buying frenzy triggered by the reporter's article. According to the China Securities Regulatory Commission's 2003 Retail Investor Survey, 42% of investors rely on news analysis from newspapers, television stations, or financial information websites. The wisdom of the market is to buy when you hear the news and sell when the news is confirmed. But what happens when the news is just a hoax? When a stock goes up, people try to understand why it went up. What they found was actually second-hand news, maybe even third or fourth-hand news. If the price rises over a long period of time, fully reflecting the truth of the news, then it's time to sell. Know your enemy. Lyft driver. They can build any pattern you want to see and reap profit from you. The chart below is an example of Lyft driver. When a stock goes up, people try to understand why it went up. What they found was actually second-hand news, maybe even third or fourth-hand news. If the price rises over a long period of time, fully reflecting the truth of the news, then it's time to sell. Know your enemy, market maker. Market makers often manipulate stocks to create patterns, support, resistance, or signals to attract investors. The chart below shows market makers trying to push the stock higher. Please note that all buyer price levels are orders from the same code 6825. Know your enemy, ambush on last trading day. The picture below shows U.S. oil futures. On May 20, 2020, most small speculators believed that the lower limit of oil prices was zero. Large speculators ambushed them and dumped the U.S. oil May contract, which plummeted to minus $37.63 on the last trading day. Know yourself as an investor. You don't have to do anything extraordinary to be a winner. All you need is to study top investors and copy their behavior. The only requirement is that you have good judgment regarding investments and their management. This is an impossible task, and we may later make a video about agency theory discussing it. On the other hand, the game of speculation is the most fascinating game in the world. But it is not for the stupid, the mentally lazy, the emotionally unbalanced, or the get-rich-quick adventurers. Ask yourself the following questions. What is your ability and scope of competence? What is the scope of your knowledge? Can you learn more? Can you enforce strict discipline? Can you control your emotions? What would you do when you are wrong or something went wrong? Are you well trained and experienced enough? Know your ability and scope of competence. It is important to know the extent of your abilities. Abilities make you a powerful player. Everyone has their own speciality, and the most important thing is to understand the scope of your abilities. Buffett's famous saying is, "The most important thing is not the size of your scope of ability, but whether you can clearly define its boundaries." If you can clearly define your scope of ability, you are better than those who have a larger scope than your ability, but who are unsure of their boundaries. Investors who have sufficient wisdom, funds, and time, are patient, have good tactical systems and plans, and can control their emotions are strong players. The market always eliminates the weak and keeps the strong. Speculators who lack one or more of the above conditions are weak hands. The market always eliminates the weak and retains the strong. If you are a weaker player, try to improve yourself before entering the market. As the Wall Street saying goes, cows can make money, bears can make money, but pigs are slaughtered. Your scope of knowledge, Sun Tzu said, decision is guided by 5 factors, which must be considered when assessing the conditions in the field. So try your best to obtain those information and know how to use them. The 5 factors are 1/ the sentiment of the crowd, 2/ the timing, 3/ the market, trading platform, and the target, 4/ the leader, 5/ strategy, tactics, planning and discipline. These 5 factors should be familiar to every general. He who knows it will win. Those who do not understand this will fail. Mass sentiment of the crowd. Bull markets are born in a pessimistic atmosphere, grow in an atmosphere of worry, mature in an atmosphere of optimism, and end in excitement. Steele comments on the bull market. Timing. Every trading action, whether you start trading or stop trading, must have a reliable and thorough basic reason to support you in advance. Be patient and wait long and hard for the right opportunity. The purpose of investing is to make a profit, not to work non-stop. There is a big difference between the attitude of "I work for money" and the attitude of "let money work for me." Some people think that they should continue trading because they have to take some money home every day, thinking that the more they trade, the more profits they will make. Many losses were caused by this. The reasons for failure are either moving too quickly or delaying too long. Know when to take action, as not taking action based on hope will not help. The longer you look forward to taking action in the market and the longer you delay, the worse your judgment will be and the more likely you are to make a mistake. Then, after you think about it, your best thinking is useless unless you take action at the right time. Everything in nature, including market timing, has its own rhythm. Cycle theory and astrology can be used to find the rhythm. The best timing to buy is when a stock declares its trend. A good strategy is not to buy at a super low price or sell at a super high price, because such opportunities are rare. The big profits are made in the runs between accumulation and distribution. Therefore, you make more money by waiting until a stock plainly declares its trend than by getting in before it starts. It is just like a race. It often takes 15 or 20 minutes to get the horses away from the post, but once they're off the race is over in 2 minutes. It is the getting ready that takes the time. What difference does it make whether you buy a stock 10, 20, or 30 points above the bottom, so long as you make profits? Timing to close the trade is when there is enough reason to do so. Once you buy or sell a stock and it moves the way you want it to, you have to hold on to it until there is a good reason or enough reason to close the trade. Look at your chart and see what the trend is, and follow it. If no clear trend is found, learn to be patient and wait. Never close a trade just because you have a small profit. Don't be impatient and exit a trade without a valid reason. The market, trading platform, and the target. We just mentioned that because most small speculators believed that the floor price of US oil on the last trading day was zero, they suffered heavy losses. So it is necessary to understand the trading rules, trading systems, and platforms. I think the importance of having adequate information about your goals needs no further emphasis. Leadership. It is difficult for one person to work in the stock market and stay correct, but it is even harder for two people to agree on the market and stay correct. If your investment advice comes from someone with a 10% win rate, and your win rate is 50%, then the overall win rate is 0.5 times 0.1 equals 5%. Loss rate equals 95%. The only way two people can succeed is if one person buys and sells, and the other person does nothing but place stop orders. It's a bad rule for a man and his wife to have a joint account together. Strategy planning. Sun Tzu's Art of War, the victorious soldier wins first and then goes to war. You may not believe this is happening. But if you look at American oil and other examples of ambushes on our channel, you should admit that Wall Street won the battle before it even began. They prepared excellent strategic plans in advance and used a trump card tactical system. Sun Tzu said, "The winners are those who carry out strategy planning in their temple before the war." The strategy plan includes a trading entry plan, an exit plan, and a stop-loss plan. The trading entry plan includes target, quantity, amount, tactic, entry conditions, and profit-loss ratio. Tactical systems. The investment tactical systems. Know how to look for winning opportunities, when to enter and when to exit, when to increase and when to reduce, when to bet large and when to bet small. How to manage their holdings. Therefore, they are able to win not because they are particularly smart, brave, or relying on luck. The only way they win is to know how to seize opportunities and attack when they must win. Enforce strict discipline. Everyone has a system, the key is self-discipline. Without self-discipline, human will not follow the rules and can only rely on hope. They become gamblers. There is a world of difference between a gambler and an investor. Lawrence Lee Basley Ongas in the book Investment for Appreciation. If you cannot follow sound rules continuously, do not speculate. The wise investor aims to succeed by following the rules, not the exceptions. Although he will always feel that somehow things are different this time, he should not give way to these dangerous feelings. Have no feelings, only reasons. Never regret not having bought. Control of emotion. The downfall of the avaricious investor is often predetermined. They are inclined to enter the market at inopportune moments and fail to capitalize on peak prices due to collective greed. Without good reasons, the act of disposing of shares driven by panic over potential losses, or acquiring them merely on the hope of gains, lacks strategic merit. Investment success isn't a function of intelligence quotient. You should be fearful when others are greedy, and greedy when others are fearful. A hesitant investor may miss out on substantial gains, hesitating to buy amidst widespread fear and hastily liquidating holdings, thereby forfeiting the chance for considerable profits. Such an investor must transcend hope and fear that his loss may develop into a much bigger loss, and hope that his profit may become a big profit. Make a mistake. Accepting failure is an integral aspect of investing. Even seasoned investors experience losses in 30% to 80% of their trades. The hallmark of a victor is the readiness to acknowledge errors, reassess their stance, and promptly minimize losses. Victorious investors take ownership of their blunders, confront setbacks with equanimity, and harness the lessons from their missteps and losses to prevent future recurrences. They remain unaffected by external opinions on their strategies, eschew biases, refrain from defensiveness or needless debates, welcome constructive feedback, and cherish the chance to enhance their skills. Conversely, those who struggle in the market often exhibit an inability to concede their faults. Once committed to a position, they seek only confirmation of their initial judgment. Their perception is selective, aligning only with desired outcomes and affirmations. This conviction in their infallibility hinders their capacity to embrace constructive criticism genuinely. They are prone to suspecting hidden agendas or disparagement from others who dare to present dissenting viewpoints. Something went wrong. Amateur traders average down because they cannot accept that they are wrong. Professional traders would never consider such a dangerous practice, as they understand that the stock continues to fall for a reason, and that there is no guarantee that it will ever recover. If the broker has to call you for margin, there is something wrong, and the best thing to do is to get out. 9 times out of 10 after one puts up the margin the first time, he will hold on until there is a second margin call and a third and put up as long as he has money to put up and lost all of his capital in one trade. A good investor must not only know how to make money, but more importantly, know how to lose less than others and retain his strength when losing money. When the market trend clearly shows that the position you originally opened was wrong, you should stop the loss and leave the market. When the situation is unfavorable, stubborn persistence will lead to total annihilation. Are you well trained and experienced enough? Wisdom is the fusion of knowledge and lived experience. True understanding emerges from hands-on practice, much like a child learns the sting of a burn only through the direct misstep of touching a flame. Mistakes are an inevitable and natural part of life. They hold potential value when we extract lessons from them. Diligently dissect each error and loss to prevent future recurrences, transforming every misstep into a catalyst for ongoing growth and evolution. Harvest both positive and negative experiences, integrating them into a robust comprehension of the market. Such profound market insight is a formidable asset. The path to wealth begins with the accrual of knowledge and insight. Losses are a critical component of the educational journey. Errors are permissible and often unavoidable. They become beneficial when they contribute to our wisdom. However, repeating the same mistake is a misstep in itself. Thus, let each error pave your way forward, scrutinize every blunder and its underlying causes, to sidestep future pitfalls. Embrace every mistake, yours or others, as an opportunity for enlightenment. For realms from rookie to master. A/insufficient investment skills and failure to realize the lack of investment skills. B/insufficient investment skills and awareness of insufficient investment skills. C/when necessary, sufficient investment skills can be used to discover conclusions and solve problems. D/investment skills are integrated into your subconscious mind, and you can use your intuition to recognize and plan your next move at any time without conscious thinking. If you enjoyed this video, please click the like button and subscribe to our channel.